So our speakers tonight, we have Judge Kalemkiarian. She's a judge for the Superior Court of San Diego. She was appointed by former Governor Jerry Brown in 2014. She put the K in Ashworth, Blanche, Christensen, and Kalemkiarian. She served in dependency law assignment and then settled in the family law. She had 25 years in the practice of family law before being appointed the judge. She was named Judicial Officer of the Year by the San Diego Family Law Bar Association for 2018, so it didn't take her very long to become a prominent member of our judicial society. She's a recipient of the Fay Stender Outstanding Service Award for California Women Lawyers in 2000. Ronson Shamoun, also known as Ronnie Shamoun, is a tax controversy attorney with over 20 years of tax experience, including 13 years in legal practice. He's helped thousands of clients find solutions to their civil and criminal tax matters. His practice includes federal and state taxation with an emphasis on criminal tax defense, tax controversy, real estate, corporate law, and estate planning. His extensive experience in representing individuals and businesses before the IRS, the Franchise Tax Board, the EDD, and the California State Board of Equalization. He brings with him tonight Brian Malloy. Over the course of his career, Mr. Malloy has developed a well-rounded breadth of experience in trusts and estates, corporate and real estate transactions, and general business matters. He counsels families, business owners, and successful individuals in all areas of estate planning, and has done so for over 15 years. Prior to joining the firm with Ronnie, Mr. Malloy served as in-house corporate counsel for a public company and was partner at an AM Law 100 law firm. He has a Juris Doctor from California Western and a Bachelor of Science from Business Administration and Accounting and Finance from the University of Arizona. We also have with us tonight our Charitable Ball. She's the Managing Attorney and Estates and Taxation Division for Antonyan, Miranda. She is licensed to practice in both California and New York. She is a recovering Wells Fargo in-house counsel where she managed taxable estates and trust administrations and supervising teams of real estate, personal property, tax, and litigant professionals. She was previously employed by a Big Four accounting firm, KPMG. She was a senior attorney editor for Thomson Reuters Westlaw, where she drafted the transactional documents that they recommend and provide for your use. She's represented on California registered domestic partner law, estate planning, business planning, and asset protection for business owners and professionals. I went to her office to kind of work out how things are going to work here tonight, and on the side of her desk, she has a collection of what appeared to be toy soldiers, but they were not the toy soldiers that I knew and loved growing up. They are Yoga Joes. April loves yoga, so I was introduced to Upward Joe, Downward Joe, Mountain Joe, Plank Joe, and I think there was Corpse Joe, but that one was a little scary. In discussing tonight and being prepared, I had indicated to her that I do practice in family law, and I do need to know the taxes and its implications for my clients. But taxes always leave me a little nervous. So I always am looking for advice and help. So the advice that April gave me tonight is anytime I'm explaining tax law to my judicial officer, I should use jazz hands. That is always effective and helping. So if there is the question, Mr. Patterson, what is the difference between the actual tax rate and the effective tax rate, I can say, Your Honor, the answer is easy. So with that, I'm going to hand it off to the first part of our presentation to April, Ronnie, and Brian.
Well, hello, everybody.
Hello, everyone. Well, first I'd like to start off by saying thank you for this opportunity to speak in front of you guys. But before I begin to talk about tax, I'm the tax attorney. Brian and I are the fellow tax attorneys. April is our estate planning / family law, trust and estates administration. So I'm going to touch on the new tax act. But before I begin, I just have to raise a hands. Who, in your own personal opinion, do you think that the tax plan is good for America or not good for America? Raise your hand if you think it's going to be good for America. Just try to get a poll. Okay, so let's just talk generally speaking. What's the tax job? It's called the Tax Cuts and Jobs Act of 2017. So what happened here? So basically, it was the first major legislation that's taken effect in over 30 years. It was a complete, 1986 was the last time the government rehauled our tax code. So since 86, been a long time. It's always been in the making. There's a lot of things that needed to have changed, but finally got passed in 2017. I'm going to touch on majority of the major topics, and of course, if any of you have any questions with these MCLEs, they're always general speaking for you to get kind of lay of the land, the bigger picture. But if you guys ever have any follow-up questions, feel free to reach out to me. The main thing is that it did lower taxes for all people. Now, there's talk between, is it better for the wealthy? Is it better for the middle class? Is it better for all classes? At the end of the day, through the last tax filing, pretty much everyone in America, more so, got a reduction in their taxes. Middle class families got reductions in taxes. Capital gains were reduced. Money was expatriated from America. So generally speaking, based on tax filings, individuals, middle class Americans, did get a reduction in tax. What it did, generally speaking, it lowered the tax rate for all classes. So it's still a progressive tax rate, so the more you make, the more you have to pay in taxes, but they basically lowered those across the board. The standard deduction was the main one. What is a standard deduction? A standard deduction is for individuals who can't itemize things on their tax returns. They don't have a home, they don't donate to charity, so they get a standard deduction for just being a person. That amount of money is reduced from their taxable income. That amount was doubled from $12,000 to $24,000. So individuals now don't have to itemize. If they're on that threshold, there's a bigger standard deduction that was almost doubled. And the other one that took place that really made a big difference for families was the child tax credit. The child tax credit was doubled now from $1,000 to $2,000. But of course, with tax cuts, there's got to be some modifications. And here, this modification was for the mortgage interest deduction. Now the mortgage interest deduction used to be capped at $1 million. Now it's capped at $750,000. There's lots of talk of being in California for the states that have high real estate values that will affect them. But then there's arguments that say $750,000 is a good threshold. If somebody has a house for $1 million, we're not going to feel sorry for them. At least that's the rationale behind it. So there's pushback and pull between whether that number should have been adjusted downwards or upwards. But I still think it's a fair amount. I think it really intends to protect the people who's intended to get the deduction for. The $750 is a good threshold. Remember, we live in California. This is a threshold that's applied across the country. So $700,000, $750 did not affect a lot of people across the country, but in states like New Jersey, New York, and California, it did affect them. It also eliminated the individual mandate for the Affordable Care Act. Before, on your tax return, you had to check a box of whether or not you participated in Obamacare. And if you didn't, you were penalized. Now, you don't have to answer that question, and there will be no penalty if you want to participate in Obamacare. So the way they got around it is they got rid of the individual mandate. So they didn't overrule Obamacare, but they basically disallowed the individual, made the individual mandate no longer mandatory, which causes individuals to now not have to purchase health care if they don't choose to. But really the main thing of the Tax Act that really was intended to stimulate our economy and where people are going to feel its effects is businesses. That's where you're going to feel it the most. Two W-2 wage earners in California, if they will pay more taxes in California. That's who it affected. If you're a single wage earner and one individual is a business owner, then the reduced taxes on the business will counter the increased taxes on the wages, and then that should balance it out. But if you are a business owner, then you will benefit tremendously from the tax cuts. There's a lot of policy behind who do you want to take care of that could stimulate the economy the most. There's always been, since 2011, we've gone through a heavy recession where I still believe till this day, small businesses are hurting. Big business is doing well, corporate America is doing well, but the small business, mid-sized business owners, they're the ones that suffer trying to make it. With labor laws, with just keeping profits up, with rising costs. So businesses needed help. So the Tax Act lowered our corporate tax rate down to 21%. Our corporate tax rate the highest tax rate was close to 40%. So there's always that artful balance between raising a corporate tax rate to a point to where do you leave? A lot of companies didn't leave. So what they did was they set up corporations in foreign countries, and the US has a back door to it. You could set up a foreign corp, you could be subject to the foreign corporate tax rate, but the minute you bring that money back over to America, that money's going to be taxed at our corporate tax rate. You still get credits for foreign taxes. So what had happened was many corporations over the last 10 years have set up shop in European countries that have stable dollars, Sweden, Denmark, Switzerland, European, you name it. There are a lot of countries that have a strong currency where these corporations were setting up shop. Now it's 21%. That allows companies to set up shop in here versus other countries. So there is a correlation between the tax rate. It's not a fixed person. You could raise taxes on individuals in America, and they'll most likely not leave the country. But if you do tax corporations at a certain level, it's not hard for them to leave. They're not mobile. They set up shop, they still operate here, all funds go to the foreign country. So by lowering the corporate tax rate, what did that do? It stimulated the economy in the sense where now these companies, whether there's buybacks or dividends being paid, at the end of the day, a lot of this money is coming back into the hands of Americans. Companies across the country are buying things, they're spending, their taxes are cut in half, they're giving bonuses to it. And so by lowering the corporate tax rate to 21%, it allows our companies here now to compete on a global basis. And it also helps stimulate our current economy. The other factor with the Tax Cuts Act is it also made a deal for repatriated cash that was sitting in foreign countries. The 21% rate would have been a good enough rate to bring that money over, but the intended legislators wanted this money to come back. There was over $10 trillion sitting in foreign bank accounts with American companies that was just sitting there, not coming back over. Once this tax act was passed, about 7 or 8 trillion of that money that was there is already back here in America. And over $3 trillion, over a third or a fourth of the tax cuts cost have already been paid through just the expatriation of taxes. So if you look at it at more of a global perspective, there's a little bit of benefits to that from bringing the money over. And then estate taxes. Estate taxes were also doubled. That was one of the main points. Before you could give a little over $5 million, now it's doubled. And the key factor to remember is not only did it double, but before, when it was $5 million, let's just keep it 5 and 1. Before the gift tax exclusion, you used to be able to gift somebody $1 million towards your $5 million exclusion. Now your gift exclusion and your estate tax exclusion is the same. So if you know any families that want to just give money away, you could write a check to your children for $20 million and it will transfer tax-free. There are methods to protect yourselves with irrevocable trust, and April could elaborate on that. But that was another change in the Tax Act. So there were a lot of, so then you're gonna go to that. Yeah, okay, and I'm gonna go into a few other details. We're kind of going back and forth, and I'll go into some of the more details, but that was kind of just generally speaking. Corporation rates went down, rates went across the board, and the intended purposes, without going into any detail, they've increased bonus depreciation, they've increased improvements on properties. Before, if you were to renovate and paint and fix up a building, you'd have to amortize it over the life of the building. Now they're allowing improvements to be deducted as a piece of equipment. So what is that doing? It gives you the immediate deduction for any business equipment that you want, 100%, and you can finance that. You don't even have to come out of pocket. You could walk in, buy a tractor for your company, sign a note for $100,000, walk out of there spending nothing, and you would get an immediate $100,000 deduction on your taxes. Let's say you're in a 50% bracket, state and fed, you have $50,000 in tax money in your hand, but you haven't spent more than 3 or 4 monthly payments on equipment. One of the most misconceptions there are with business deductions is that they have to be paid. Anything for a business that's financed can be deducted as well. So we haven't seen yet the effects of how this is going to be, but businesses across the country need incentives to grow, to invest in their companies, so that in turn, things move and hopefully the economy gets better. Yeah.
Thank you. I was going to say, I know people you could give a gift for $1 million. That'd be great. People would take it. So first up, I'm going to talk about the state and local tax. So for your purposes, I'll just briefly go over some of the nuts and bolts of state tax. So the governing authority is the Franchise Tax Board. I'm more scared of them than the IRS, to be frank.
IRS is an angel compared to
Yeah.
the state tax agency.
And the governing law is the California Revenue and Tax Code. And I'll just talk about the top rate in California for tax purposes is 12.3%. Probably most people fall into the 9.3% bracket or 10.3, but 12.3 is the highest bracket. And for corporate tax rate, it's 8.84%. S corps, what are like a partnership, is going to be 1.5%. So it's a lot different than the federal rates, a lot lower. I get a question all the time about how do you calculate effective tax rates. So what you do is you take the total tax and you divide it by the taxable income. With the law changes and how they're reporting on tax returns, it's a little bit interesting finding the total tax on the California tax return. Most people file a 540. I think you can use line 35 and divide it by line 19. That's the tip. You will see that there's a total tax on line 31, but there are credits in California that you can take. They look small, but in the tax world, tax credits are fun. Tax credits are dollar for dollar reduction of your tax liability. So in the tax world, we love tax credits versus deductions.
But I'm going to just comment on effective tax rate. That's always misconstrued because it is after deduction. So you're going to take total tax divided by income. You could have made $100,000, donated $50,000, have $50,000 of taxable income, and you're going to pay an effective tax rate of X. But you don't know how you got down to that effective tax rate. Did you buy some equipment? Did you depreciate something? You could have done they have accelerated depreciation methods in property. So effective tax rate is used a lot, but it doesn't really tell you a lot unless you actually see the return, because a lot of things reduce taxable income, but it doesn't really tell you really what's going on in an individual's tax return. So when you see that, look at it with a little bit of a grain of salt, because you need more information to make a determination of what it really means.
Yeah, and then also sometimes you'll hear people talking about actual tax rate, what the last marginal tax rate is in a tax bracket, but that might not be their effective, right? So it's easy to manipulate these figures for, if you're in a family law situation, you can come up with a figure you might need to use for your calculation, but it's interesting to play those numbers. In California, one thing to just think about is if you have a client that has a limited liability company, limited liability companies are taxed a little bit different. All entities in California have a minimum franchise tax of $800. LLCs, if you get above $250,000 in gross receipts, then they start taxing California sourced income in different brackets, just flat rate. Lowest one is $900 extra. They got dinged on that a few years ago because they were taxing on global income versus California sourced. So now it's just California sourced. Effective tax rate for businesses is just total tax expense divided by earnings before tax. So that's a little different calculation than you might be used to taking if you look at a return. The interplay with California tax law and federal tax law is interesting in job security for tax attorneys because California comports with federal law as of 2015, not 2017. So in California law, the TCJA doesn't exist for many purposes. California follows the 2015 rules with some exceptions, because we always have to have exceptions in the tax world.
One of the main exceptions was that is just accelerated depreciation and some of the accelerated write-offs. So the federal government allowed immediate deductions for those big expenses to encourage you to spend the money now, but California did not follow those. And California has a lot of state and local taxes. Many Californians don't feel the effects of the TCJA because of A, they don't follow it, and B, for some of the accelerated business expenses, and C, we just have a lot of state and local taxes already. And so it's just, we have an environment where there's just, we have a lot of taxes already just being citizens of California.
That's right, so that goes into, so you'll have in your handout some attachments. It's listed as attachment 4, which is business expenses. And those are just printed out so that you could see specifically how federal and California, for business purposes, what expenses are there, what deductions are different, where to find a publication if you needed some more information. And the depreciation is the main key, as Ronnie said. So you can look at that, that's just for your information. And again, the IRS publications are pretty user-friendly. That's why we like to have these handouts, because we hope are in plain English.
And depreciation is liked by banks because, it's just a paper deduction. So depreciation is they're deducting its use. You have to recapture it when you sell, but depreciation is, banks realize that it's a tax deduction versus actual cash flow. So when banks look at your tax returns, when you encourage some of your clients to spend in their business, buy equipment, invest in it, if they're getting the immediate deduction for it and it's depreciation, you're getting accelerated depreciation, the banks will add back that deduction to increase your cash flow. So they basically, just like for example your home, when you a building that you buy, you depreciate the building versus the land, and you get little bit by little bit over 37 years, the banks would add it back. So it's one of those tax benefits that you still could look good in front of a bank and still reduce your taxes at the same time.
Right. I think for family law, the biggest tax change is in spousal support, the taxation of spousal support. So we know that if this agreement has been signed on or before last December, then the payor can deduct and payee shows income. As of 2019, the federal taxes do away with the tax consequence on either side of the spousal support payment or receipt. But in California, they didn't. So for California purposes, federal return, normally how you calculate your California return is you do your federal first, and then if you're doing TurboTax, it says, do you want to add a state, right? So then you have your federal figures, and then you adjust the federal figures for California purposes. And so that's what's going to have to happen starting this 2019, this tax year, which is for federal, there's nothing going to be reported. For California, you'll need to make an adjustment for California filing purposes. We have attachments on these as well. Listed as attachment 3. This is something that's called alimony. So in the tax world, spousal support is considered alimony in the statute. So we use those terms interchangeably. The Alimony handout, first off, is out of date. It hasn't been updated for a number of years. But the reason I include it is that number 12, so second page of that, has a real good information about what kind of penalties will I be assessed. So California has this reasonable accuracy related penalty. So that's how that franchise tax board normally deems people when they're going after them for misfilings. Is they say, well, it wasn't reasonable, it wasn't accurate. And so I like including this handout simply because of number 12, because it gives you some resources and some law to talk about what happens if you get a client call that says, my tax return wasn't accurate and I got this letter from the franchise tax board, and they can read that while I refer them to you.
Yeah, so penalty. At the end of the day, state or federal, I would always just recommend to do the good cause, reasonable cause. Always try to get your penalties abated with any California franchise tax board penalty or the IRS. The IRS right now is going through a whole new system. They had a policy in their system where all penalties used to need management approval, and they were going through the system without management approval, and now they're revamping the whole way they assess penalties. They have a new first-time penalty abatement program. I have a 90% success rate on penalty abatements in our firm, and it's not because I just know what I'm doing, it's because I try, and if I don't get it at the first time, you appeal it, and you get a second chance or whatever you're dealing with. Reasonable cause in a nutshell means any specific event, a death an illness, a sickness, something that caused you and that person during that state of mind to lose control of their state of mind because they were depressed, they were sad, they were caring for a loved one. If that happened, and during that time, this mistake happened or this was happening, the governments will abate your penalties. The state of California does it all the time. It is sad how many people never tried to get their penalties abated. It is something that everybody should do because the state and the feds, even the state, for as bad as they are, they abate penalties as long as you try. And if you guys ever need any feedback on it or anything like that, you're always more than welcome to email me or our team and we can help you with that.
I have a question. Is that what you're saying right now? Does that include delinquent filers?
Yes.
Okay.
Even the failure to file, failure to pay, all the accuracy-related penalties, the delinquency penalties, even informational return penalties, everything. Yeah. Those are the main ones, the failure to file and the failure to pay. That is key, you know, so you can be on a payment plan after the fact, send them a letter saying, I couldn't pay my taxes in full because my aunt got sick and I've been spending the last 4 months in North Carolina caring for her and I'm broke. That's all you gotta say. And then the IRS has a first-time penalty abatement program that you could literally pick up the phone on any first-time penalty. Most likely, they'll abate it over the phone. If they don't abate it over the phone, submit a penalty abatement request, put reasonable cause, something that caused you during that period, and it will get abated. So the main ones are the failure to file, failure to pay. Late filing penalties are very, very common, and those are severe. So either one of those are the most frequently assessed, and those are the most frequently abated.
Yeah, abatement is one of our favorite words, right? The other two attachments, attachment 1 and 2, go together. Attachment 1 is the life cycle series. It's a nice handout just so that you have a list of publications that might apply to certain tax questions that might come up. On the second page, the innocent spouse relief, I get that question a couple times a week. You know, I got this tax letter, I'm the innocent spouse, my bad soon-to-be ex-spouse did something terrible with the tax return. And so while we're referring them out to their CPA or to your firm, I like to give them a publication to read so they can calm their nerves a little bit. So that's what attachment number 1 is about.
But anytime anybody's contemplating innocent spouse, there are a lot of rules to it. I always suggest, and not just because I'm an attorney, but I always suggest for that topic, it'd be best to consult with somebody who knows what they're doing. Not that they need to be retained to do it, but you could shoot yourself in the foot. Most innocent spouse requests that I read have been attempted by the individual. They've submitted the innocent spouse, and then it comes to me for the appeal, but they've already made statements within the innocent spouse that hurt them. You know, you share in the wealth, you do share in the debt. So for example, if two individuals are living a high lifestyle and they're both enjoying these millions of dollars, and all of a sudden there's an event, it's hard to claim innocent spouse when you've reaped the benefits of that. But if either spouse was completely not aware, this is a global explanation, and did not benefit, that's the second, did not benefit from the ordeal, whether it's income, whatever it may be, then they have those defenses. But innocent spouse is granted all the time. From what I understand it, with family laws, at the end of the day, whether it's granted or not, then the family law court's going to determine who owes what and then allocate things according to that. But innocent spouse is something that should be pursued when spouses are truly innocent. And the main one that I see most likely is when they get a tax bill or there's a tax situation where they owe a bunch of money and they got audited and there was an omitted item on the return. And they did something and they never reaped the benefits of it, then that is something that's the main choice for innocent spouse.
The last handout for attachment 2 is publication 504. That is the updated IRS publication as to alimony or spousal support. So that is a nice sort of a short-term little cheat sheet for you on the taxation for alimony from IRS purposes and the different taxation rules on that. In July of this year, our Governor Gavin Newsom signed Assembly Bill 91, so AB 91, which changed some California tax laws to comport with the TCJA, but not all, because we can't actually come together super quick. That would be too simple for everyone. So I'll highlight just super quickly some of the things. May not be in the forefront of your practice, but it's good to just have it in your back pocket so if someone mentions it, at least you can know what they're talking about or carry on a conversation. First thing is California is going to comport with the TCJA on the net operating loss, no carrybacks. So no carrybacks. You used to be able to carry a net operating loss back, amend tax returns, pick up some extra tax dollars, but they're not going to allow that anymore. California is going to comport with that, but just beginning 2019. So that's the first coming into alignment with the TCJA here in California. Other one is excess business losses for non-corporate taxpayers. You won't be able to deduct them in the current year. You might be able to carry it forward. Excess business loss, again, is just a way to suck up some taxable income. It's for non-corporate taxpayers, so that's individuals, that's partnerships, and that's trusts, because some clients will set up a trust, try to do business in the trust to kind of save their assets. And so that's where we see a lot of these actions with excess business losses. And then just like the TCJA, California's, if your adjusted gross income is high, so if you're a high earner or you're a high taxpayer, 1031 exchanges are going to be limited to real estate. So not everyone knows 1031 exchange of real estate. You could also do it with tangible personal property, but they're taking that away for high earners. That doesn't necessarily hit everyone every day, but when I was in-house at the bank, it hit us every day.
And that would just, in a nutshell, it's mainly limited, just to give you a general, it's just a real property is really the main factor now. You used to be able to kind of exchange businesses to other businesses, now it's limited to real property. And did anybody know, should I go elaborate what a 1031 exchange is? Did everybody know, who knows what a 1031 is? Okay, so good. Just real quick, that a 1031 exchange is you buy a property for $100,000. You sell it for $500,000. You'd have a gain of $400,000. You could sell that property for $500,000 and buy another property for $800,000. Basically, you wouldn't pay any tax on that $400,000. Your basis, that gain would just move. You would exchange into that, and that additional gain from that prior property would be deferred into that other property, plus any additional gain that goes up until that property's sold. So 1031s are basically tax deferrals. You're just pushing it on. Eventually, there'll be a reckoning day where the taxes will have to be paid. But you could but it allows people to just exchange into other properties and still have enough capital to go into those properties.
A couple more items that AB 91 brought California tax law into compliance with TCJA for federal purposes is in the sale of a business. So federal law allows under section 338, if you are doing a stock purchase, you could treat it as an asset acquisition. So all this means is if you have clients that are divorcing and they're trying to, sell or transfer the business to one party, normally you can do an asset sale, which people like, because then they get a jump up in basis and eventually defer tax gains for later. But if there is a license or permit in that company, you can't transfer that, right? It's hard to sell that. So I had clients that had a liquor license, and you can't transfer that, but you can transfer the stock ownership, and then the license can go with the owner of the corporation. So it used to be that California said you could do your own election, doesn't matter what you do for federal purposes, but for California purposes, you could do something different, and that wasn't working out so great. So now they're saying, if whatever you do for federal purposes, we're going to follow through for state purposes. And along the business lines, there was this weird little tick in the partnership law that said if you sale or exchange 50% or more of partnership capital or profits in a 12-month period, then technically the partnership is going to be terminated, and you got to file a final 1065, a final partnership return. That doesn't seem to be very good idea, especially in family law. If you're transferring ownership, you don't want the partnership maybe to end, you just want to transfer ownership. And so AB 91 does what TCJA did and closes that ridiculous gap for that. I will say, just looking forward quickly, in 2020 in California, there's going to be a mandatory health coverage mandate. So that's going to be something that we're going to see for the 2020 tax year, and we'll see what exceptions there are. There's a long list of exceptions, so it's not like it's going to get everyone, but their anticipated penalty for people that can't comply with that or find an exception is going to be somewhere between $800 and $2,000. And then there's rumblings that they might tinker with Prop 13 for property tax purposes for commercial property first. So that's something that's on the horizon. Maybe given the time, I might jump into just super quickly the joint tenancy and estate planning, and then you can round it out with your talk, if that's good.
Whatever you say.
We'll jump in. So just switching.
Yeah.
So just switching gears.
April, real quickly.
Oh, go ahead.
I have a question with respect to the federal changes to the spousal support. Since the payor no longer gets an above-the-line deduction, do you see any incentive for not paying spousal support? And do you think that's going to affect increased court battles and for the litigation?
Well, we hope so, court battles,
Yeah.
right? That's good for business, depending on which side you're on. I don't know. What do you think from a practice standpoint? Do you think there might be more battles since the taxes have changed?
So meaning, since you don't have the deduction, so let me just explain it again just to make sure the crowd understands it. So basically the policy behind it is before, as you may know, there was a lot of tax planning between spouses. So one spouse was, let's say, a higher wage earner, and then the other spouse wasn't a wage earner. And so I used to consult a lot with running thresholds. How much money should we get out of here? And we're going to reduce, he's in a 30, or he or she's in a 39% tax bracket. So let's do that. Let's increase child support. Let's maneuver. So there was a lot of maneuvering going back and forth. So under the new Tax Act, they got rid of the deduction, pick it up. It's neither deductible nor income on either sides. So now there's no, what they used to call tax rate, game, or whatever the word was. So what Brian was saying, so since now you don't get the deduction anymore for it, since it's not a deduction and not picked up as income, will that cause more people to not pay their child support because they're not getting the deduction for it anymore?
They don't have a choice over whether or not they're going to pay that child support. The child support is still going to remain the guideline child support, and that's going to get ordered. As far as reducing,
I'm sorry, alimony. Sorry, I meant
on the spousal,
Yeah.
You're still going to have people who need the spousal support, so they're going to go in. You might see people trying to be more creative and trying to generate money now that there's no longer the tax write-off. For instance,
I'll tell you, Mr. President, across the state, judges aren't seeing any change in people's behavior.
Right.
Which is
Okay.
quite fascinating. We thought we'd see a lot.
Okay.
I mean, unless you're, what's her name, Jennifer Lopez, or somebody who's, where there's so much at stake, or you've got a very high wage earner in a long-term marriage, most folks are still just coming in, tell me what it's gonna be, how many years, which surprised us.
I just see more creativity and ingenuity in trying to find ways to create the money where there's no longer this tax incentive. But the battles are still going to go on.
And the
because
amount's going down. I mean, if you
Right.
run this semester and you put it, which I'll show you, do deductible and then you do non-deductible, it jumps. So the judges are ordering less, of course.
Right.
We should be.
Yeah,
That's
well,
that.
and the Family Code Section 4320 is a statute that governs permanent spousal support. And one of the elements of that, as Judge and Mark can confirm, is the court is supposed to consider the tax consequences to the
There aren't any
payor
anymore.
and the payee.
It's
And
outdated,
now
it needs
it's
to be
gone.
amended.
Well, you got, but you're gonna consider it.
Well, yes, except that it's.
For a
now
second.
You're checking the box, they're equal, but, that's where you end up.
I have a question. If you, I don't know the history of alimony, but if you don't pay it, can you attach liens to their property? I mean, what happens if you don't pay it? Because if there's no problem, there's nothing that's gonna make them fear. I'm just curious.
You have to go in, you have to get an order set on the arrears. Once you have a money order or an order from the family law court set on the amount of arrears, that's a money order. You can use a money order to enforce, you can put liens on property as you're asking. So there are ways to affect that, but let's make sure we get back to the presentation. I think we're going to go to the
So-
states and planning.
So I will, you want me to jump in? Or-
Yeah, jump in and then we'll go to estate planning for a couple
Okay.
minutes.
So I just wanted to touch on a few points. So the Schedule A and Schedule C, because that's the individual returns and just some of the changes to be aware of. We did talk about it initially, which was the mortgage interest deduction. Now that is $750,000. It was reduced by $250,000, but it does not affect people who had the loan prior to a certain date. So if you had the $1 million mortgage, then the Tax Cuts Act came forward, you still could deduct up to the $1 million of mortgage interest. This is for future after the Tax Cuts Act. Charitable contributions, they did increase it. There used to be a limitation for how much money you could donate to a charity. You could only donate up to 50% of your adjusted gross income to charity. They didn't want you donating all of your money, getting a deduction for all of it, but they would allow you to at least deduct 50% of your income. The Tax Act raised that up an additional to 60%. So now you could donate more to charity and have to pay less taxes. On a Schedule A, there's another line item, which is medical and dental, which was on the top of the Schedule A that allowed you to deduct medical and dental expenses. There was a limitation. You could only deduct what was greater than 10% of your adjusted gross income. So if your adjusted gross income was 150 grand, anything over 15 grand you could deduct, anything less than that you cannot. And now they made it 7.5% of your adjusted gross income. So the threshold from when you could deduct was reduced. The big one that's caused a lot of feedback and a lot of is the unreimbursed business expenses. Now, as a tax attorney who does a lot of IRS audits, I can tell you that was one of the most abused categories in the IRS. A lot of people would just deduct unreimbursed business expenses. And what it means is if you have expenses for your business that you need or want for your business, and they are not reimbursed and they're unreimbursed, then you could get at least a tax deduction for it. And so it hurt professors tremendously. In academia, fellow professors of mine that are more tenured, that travel, they're used to traveling across the country, spending their own money for their careers. And there are a lot of careers where you need to spend your own money in order to advance in your career, to be well at your career. And you don't mind doing it because you get a tax deduction for it. And if you're in a high bracket, especially living in California, anything that's a tax deduction, you should, if you need it, just spend it because you're getting more than half off. And so now that was abused, but that's no longer available. W-2 wage earners now don't have a way to deduct their unreimbursed business expenses. The only way they could kind of hopefully get around it is if they have some sort of business interest, if they have some property that they could use, a business that they could tie it to. But if it's two W-2 wage earners, that was one of the biggest ones that was deducted. But that was the biggest most abused. You know, any industry, there were always deductions for unreimbursed business expenses. So it was used by so many people that didn't really qualify under the criteria. There are criteria for it. And then tax preparation fees used to be deductible on your Schedule A. Those are no longer. And theft and personal casualty losses were allowed under personal tip return. Those theft losses are no longer allowed under personal tax return. Those were very abused. Those were not following the law. And then whether you decide to incorporate, so the Tax Act, you could either operate as a sole prop, which I recommend no businesses should operate as a sole proprietor, period. Just period. For the limited liability and just for the extra corporate benefits, a company car, a lot of things that you write off to a corporation are rarely ever scrutinized as they are in a Schedule C. So I always advise everybody to take advantage of that. Whether or not you do choose to incorporate or not, the talk about the lower corporate tax rate got the average person saying, well, then you should incorporate to benefit from the new Tax Jobs Act. But you don't have to. Even a Schedule C will get a 20% deduction, which is basically a reduced tax on your income. So it does apply not only to corporations, but it also does apply to Schedule C businesses. So you don't have to incorporate. If anybody is operating and you know a business and they're a professional, California has made it harder and harder now for individuals to be considered independent contractors. I'm getting a lot of talk from companies now with AB5. How do we get around this? The simple way, I mean, it's not that easy, but if all of the contractors operate as their own corp, then the state cannot reclassify a corporation to an individual. So any companies that have just a few, and then the other ones, if they don't want to operate that way, you got to have to beef up the contractor relationship. But that's the way to get around it. I saw a question right there. Did you raise your hand?
So you're saying that if an individual independent contractor goes as an LLC under Dynamex and AB5, the state can't?
Nope. That was always what I used to advise people before. I do EDD work, and we have all these contractors, and they would get audited, and the EDD would come reclassify independent contractors to employees. Even before, they'd say, well, we would have to break down the category. These are drivers, these are this, and we'd have arguments. The state determines whether an employee is an employee. It's by your actions. It's not what you write down. So they would go back and assess, and then they would convert people from independent contractors to employees. If you don't 1099 a person, and they are in fact an employee, you are not only responsible for their employment taxes, but you are responsible for their income taxes. So that's the double whammy. You would end up having to pay almost 50% of the 1099 for their income tax and their payroll taxes.
So I hate to jump in, but we need to get to the estate planning portion of this. We've got about 5 minutes, and then I have a couple of questions. So I throw it to you, April, to go to that portion.
So we'll just talk quickly then about joint tenancies and severing them. So one thing in the middle of a divorce is sometimes people die, and you don't want in a joint tenancy situation the survivor to take all, perhaps. So one thing you just need to be mindful of is maybe sever one of the 4 unities of time, title, interest, or possession. So maybe that's just create a deed from yourself as a joint tenant to yourself as a TIC, a tenant in common. There is a new government code as of 2018, which upticks the filing fee on deeds where tax attorneys used to be able to be smart enough to outwit most of the document transfer tax and so forth. But there is this new government code. So if you're telling clients it'd only be like $20 to file, it's more like $75 or $100, $225, unless that particular joint tenancy or any real estate is owner-occupied residential dwelling. So that's something to keep in mind. Quickly, for gift tax, as Ronnie mentioned, we have the unified credit, so that 11.4 is for estate and gift tax. No gift tax is triggered on any property settlements or any transactions in a dissolution, but sometimes people want to trigger a tax so that they can, instead of get a transfer basis, again, get an uptick in the basis for a property that they might consider a sale, pay capital gains now, at what they perceive as a lower rate and then lock in some appreciation for later. So for some clients and a ultra high net worth, triggering a tax isn't always a bad thing. California has no estate, no inheritance, no pickup tax. We've done away with all of that in 2000. The latest was 2005. But this year there was this SB 378 with a proposal for 2021 for California to have an estate tax that was equal to the Fed tax exemption amount in 2009, which was 3.5 million. So that did not make it any further than just kind of a talk and some write-ups. But it is interesting to see California back talking about having a estate tax, and then just talking a little bit about estate planning. It's important even during a dissolution to just think about estate planning. You don't run afoul of the ATROS, the 2040 issue. If you create a will and powers of attorney and even create a trust, you don't fund the trust, you don't touch title, but at least have something so that the soon-to-be ex-spouse isn't making your healthcare decisions, because I always tell clients they're going to pull the plug if you have a hangnail. So with that, we can end on a high note.
Yes, the hangnail. No. Had a couple of questions, and then we're going to hand off to Judge Kalemkiarian. There's a question: the $750,000 mortgage interest, does it apply across the board or only for new mortgages?
Once the date was set, if you had a prior mortgage before that, then the million would remain. So it's across the board today if you were to buy a house. But if you had the house with the debt of $1 million prior to the date, I don't have the exact date off my head, then you could keep it going forward. So it's across the board now for everybody.
There's a question in regards to a probate case. The decedent fails to file taxes for several years before death. Can the estate have penalties abated?
Yes. I do a lot of penalty abatements for estates all the time. A lot of times if the person is incapacitated prior to that time, but yes, estates can do penalty abatements for any penalties that are assessed on the estate.
The question: if a support order, which is fully taxed, is subjected to retroactive modification and the repayment occurs in a later tax year, can you file an amended return or deduct in a later year?
You would just deduct in the year that you paid it. You would just take the deduction in that year. You wouldn't go back and amend.
And I'm not sure if we have anyone here on the board that can answer this one, but the question is, since spousal support is no longer taxed at the federal level, does that mean thousands of support recipients in California will be eligible for subsidized health care insurance on covered California?
Let's hope so.
Yeah.
But the answer is no. I mean, it's not going to affect it. It's just going to be picked up. Whether it affects the tax, it won't have any effect on that.
And then I have a question, and that is, do you think California is ever going to catch up with the TCJA?
No. I mean, for what it looks like, I mean, California is doing their own thing. I mean, it's if anything, it's going to be no.
And with that,
I want to be quick. No. I've spoken enough here.
Sure. I have a few overview comments, but do we want to dim the lights at the end?
Yes.
In case I want to play with this semester. I just want to make a couple of overview comments which really reflect my thinking making that transition from being a family law attorney to being a judge. And that is number one, always remember what a judge does. We are supposed to exercise judgment. And that seems obvious. It wasn't obvious to me what that really meant till I had to do it. And what I mean by that is, we are not there to know the answer. And as a practitioner, I often went into the court and I was just hoping the judge was going to tell me what to do because I wasn't sure. That's not the role, and that's not where you get the best result. my job is to exercise my judgment. That's why the standards on appeal are, did she abuse her discretion? Or did she make a flatly wrong decision based upon the law? So when you're coming to me with an issue that involves anything, but let's talk about money, you're asking me to assess first the credibility of the person who's giving me information, whether that's your client or the expert. And that credibility assessment is the number one thing that I feel I'm trained to do. Who am I going to believe when there's disparate facts? And in the money arena about earnings, there's almost always disparate facts, even if you're just a W-2. The second thing is I'm supposed to assess the law and make a judgment as to what interpretation of the law is correct. Because we know the law is a moving target. It can mean many things. And if you've got a judge who's newer to the bench or newer to family law, please tell them the law. And I find often people hesitate to do that. You think judges are going to be insulted, or it takes a little more time. You have to charge your client. But it will so much save problems, because you don't want a judge making spousal support orders or making determinations about Schedule C deductions, business expenses, and other things if they don't know what the law is. And it doesn't take that much time to do it. You don't have to overwhelm the judge, but I have to make a judgment. What does the law mean? So tell it, give me the law so I know. And the last thing is, of course, I have to make a judgment about what facts are going to be most important to my determination, which blends in that credibility issue. And when I'm trying to make that judgment, again, I need to know the facts in a way I can understand them. And I think there is no area in family law litigation or even just your motion practice where it is harder to understand than when you start talking about tax returns, tax issues, and how they affect the determination I have to make, usually of value or income. Along those lines, do not come into my courtroom with a high wage earner who's got a complicated situation and expect, number one, your client to explain it. How often does that go well? Or number two, you to explain it. Because generally, you don't have the expertise, nor should you be giving clients tax advice. You want that to be coming from one of these people. And you want to look for someone who, like these folks here, can explain it clearly to the judge. Because remember, I'm not an expert. I'm not going to know the answer. I'm going to have to listen to what you tell me and make the judgment about who's credible and what law and what facts I'm going to take into effect to make that judgment. Now, given that, what I'm going to focus on tonight in these few minutes is to do a demonstration. And to do that, let's just first look at the dissemesters I've held out. Fortunately, I should say, most of you are coming in, particularly the South Bay, Thursday and others who come down there all the time. But we don't get a lot of, complicated, very high wage earners unless they're from Mexico. And I say that seriously, because the Mexico situation causes all types of interesting wrinkles. How are they taxed there? Are they paying taxes here? There's usually two sets of taxes that are being paid. How am I going to take account of that as I'm making a calculation of support? And particularly when we're talking about spousal support, it is entirely my judgment. So don't think I'm going to be going by, I can use a dissemester for a temporary order, but those are the easy ones. I mean, the hard orders are the permanent orders. And if you've got a situation like a high wage earner from Mexico and they live here and they own homes in both places, it's my judgment on what I think people need. So again, making those arguments in a way I can understand them based on the facts is very important. Well, I ran some scenarios just looking to try to demonstrate how important it is to tell me where to put the dollars on the dissemester. And to know when you're dealing, even if a guy owns an auto shop or a junk business, or he's got an LLC with his sister and brother and they do powder coating. I mean, what they're doing and how they file their taxes is extremely important to me. I find that many practitioners, because we're scared of it, do not look at the tax returns of the opposing party in enough detail. And so before you come in for a spousal support order, particularly a permanent order, really be sure you've looked at that last year's tax return of the parties, whoever on your side, and of their business, because there's so much information in there, or get one of these folks to give you a few hours to do that.
If I could just comment, there's a lot of tricks on that with the tax return. So if you look at last year's tax return, it may look like there's not a lot of income on there. So never trust the other side's tax returns as being what it says, because there's so much going on.
You've got to dig into them, and
Yeah.
you've got to have someone who knows what they're looking at, and I'll give a couple examples. So, number one, at the bottom, you'll see I made these. This is a very straightforward this semester calculation. I made one mistake. I should have put 3 exemptions for mom, but it doesn't matter. So, wages and salary, dad's at $62.50. It's about $75,000, I think. Mom's at $33.33. 2 kids, 20% timeshare. All right, pretty simple. $13.45 in child support, $209 in spousal, total obligation of $15.54. Everybody with me? Simple one, okay? Now go to number 2. In this scenario, I presume he was a self-employed person, one of these sole proprietors that is being frowned upon. But whatever he did, he filed his taxes as a self-employed person. Same numbers, $62.50, $33.33. Now he's paying $13.45 in child support. A little bit of a bump, not huge, but you know how your clients don't, they want to get all that money. And he's paying less in spousal support, $165. His total obligation is a little bit less, $14.58. Now I couldn't tell you why, unless I opened up the DissoMaster and got into the taxes and we saw where the numbers changed. But the point of this is it makes a difference. It gets more dramatic as we go. So put them, am I over?
No, I think the laptop.
We're trying to make sure.
Oh, it's okay, I'll deal with it. So put the, tell me where to put the numbers, because the numbers do make a difference. Now let's go to number 3. And in this case, I had it all listed as other taxable, and if I opened that up, I was presuming that he was coming from a partnership. Okay? $33.33 again for mom and wages. Now we've got a jump, $14.79 in child support, so that's gone way up, and $18.08 total, so $3.29 in spousal. That's a major difference. If you come into my courtroom and said, he's got an LLC, it's a pass-through, just put it in his self-employed income, you've suddenly made a pretty substantial mistake for your client if you're the supported spouse, because it's going to make a difference. Why? I think because of the new tax laws, primarily, that this is supposed to demonstrate. Then we have a last scenario, again, where I put in some of the W-2 income, because a lot of the folks who have partnerships are paying themselves some W-2 income for whatever reason, to get health insurance, to deal with some Social Security, whatever. And then the balance made it as something that was coming out of a partnership. And in this situation, again, the numbers changed. So now child support's about the same, but the spousal support went down. Now, all of these numbers are sort of in the ballpark, but they're dramatically enough different, particularly if the numbers start to go up. Let's say this guy was a $100,000 partnership, or $125,000 or $150,000, you would start to see this move a lot more. So the lesson here is just, it does make a difference, particularly on the payor side, where you put it, and not to be very general about that, and not to fail to recognize where you want me to put the money. And don't hesitate to tell me if I put it in the wrong place, and you get the printout, you say, no, Your Honor, you put it there, or when I'm calling it out if I didn't put it in the right place, because it is going to make a difference. Now, there are some things, and now you can put the lights off, which it occurred to me as I was thinking about this. I think with the new tax law in particular, folks with the DissoMaster are not necessarily remembering to do. Now, everybody knows you go to this tab here for other taxable income. And this is where, again, looking at the tax returns, getting the advice of a tax expert, because each of these areas are taxed at a different rate. That's why the DissoMaster has separated them. Well, not all of them, but most of them. So what are the capital gains? And it's telling you right here where to look for it. What are the dividends? What type of dividends? If they're heavily invested, Social Security we know about. What are losses? So this area here is well worth your time to talk with a tax person if you've got a high earner to make sure that you're getting it right and that you're telling the judge where to put it. Royalties has a little explanation here as to where you're going to find that information. And then, this is interesting, for the partnerships, you want to know what portion of that is subject to the self-employment tax, because that's going to be relevant. And then what portion, I had to look this up because I didn't even know what it was. The NII is the normal, help me out here.
Net interest.
Sorry?
Net interest.
Yes, that's right, net interest. So all of these are defined, and I'm sure most of you know this. I use this all the time. I go up to help on the DISO master, so I go into the manual to see what I'm looking at and look up a term, because I don't always know what they are. But this is going to impact the income available for support depending upon how you put that in for the partnerships. Rental income, et cetera, we know. Then there's the other non-taxable income. We're very familiar with that in terms of our military families, et cetera, which isn't even listed here, but we know where to put it. The other part where I think we are often missing, leaving stuff on the table, so to speak, on either side is here. First, there are these itemized deductions, which we know we always put in property taxes, deductible interest expense, but there's some others here that we're not putting in regularly at all on cases. Again, probably doesn't come up unless you've got a pretty high income case, but the charitable contributions, the state tax deductions, the state sales taxes that have been paid, if the program we're going to presume is accurate, the law makes me presume it's accurate, it's doing those calculations in its little Wizard of Oz way behind the computer, but it's maximizing the income available for support when we put those deductions in, and they can be extremely significant. With the new tax law too, and we talked about this at our panel, Art Grader, when we asked him about the property tax, what does it do with property taxes in the program, he says, well, you have to know the deductibility limits yourself. So if you've got somebody who's one of those over 700,000 homes and they're paying a huge property tax or interest deduction, you have to know that so that you tell me, oh no, you can't put that all in, you can only put a portion. I haven't seen a case like that yet, but you know, it could happen, and one needs to be aware of that. The other thing that I think is not being done at all, which again, I don't know because I didn't have a template that I could use to figure this out. I haven't yet seen anybody come in and fill in the alternative minimum tax section. I didn't even know it was there, to tell you the truth, because I've never had to use it. And I was reading the manual after I was reading the tax information that we were provided and said, whoa, if somebody was using alternative minimum tax and that's how they were filing their taxes, and those itemized deductions are no longer important, I need to put that information in here. And it comes right off of the federal tax form. So again, I'm not a tax expert. As the judge, I'm not going to initiate that inquiry. But if you're trying to maximize support or minimize support, either way it's going to help you, I would be sure to flag that to me. Now, this little feature here is extremely helpful, and if you haven't used it, how many people use the DISO Master Manual? See, a lot of us are really afraid of it. So let me just show you, if I put in AMT here, it brings up this whole discussion of what the alternative minimum tax is and what effect this has. So I just urge you to not be afraid of this feature and to look things up when things are coming before you that you're not quite sure how to handle. The DISO Master calculation, the other thing that comes into that role of discretion is this. If you're coming in to me for a permanent spousal support order, and I'm going through the 4320 factors, and I'm weighing everything, one of the things that I'm weighing, particularly when there's kids, is just how much money is in everybody's pocket. And this raises first is just a footnote. The issue that Ronnie raised a while ago, there are, and I hear now with the new tax law as well, you really, if you've got a guy running a big business, and I represented a fellow who ran a limousine company, to remain unnamed, and they depreciated the heck out of the cars. It took me a long time to understand whether that depreciation should be added back in or not, and how I was going to present that to the judge as to the money that, because it was quite a substantial amount, and these guys took a regular distribution from their partnership, which sometimes was more than their profit. So if depreciation or amortization is now changed, you need to understand that from your tax guy. So when you come in, it's not going to show up anywhere here in a way that's really helpful. That's going to have to be an off the disso master. Well, there's a depreciation tab. I'm not sure what it would do with that, but those are arguments you want to make to me as to the money someone has in their pocket, particularly if they're living higher than what it shows that their disbursements from the partnership would cover. Now, the other tab that I'll disclose, one of my most used tools here, is if I'm doing a permanent spousal support order, I'll block support, because all the judges are taught, never, 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 you'll get appealed, never, never, never look at that for permanent support. So I always block it, so my mind hasn't even had it flash across my face, okay? However, I look at this, and that's cash flow. Because I'm really trying to determine what kind of an order do I now make. I blocked spousal, that's the cash flow with child support. What kind of an order am I going to make that's going to be in keeping with the 4320 factors, with the well-being of the child, and with the ability of mom to get on her feet, with all the other things I have to assess. But while this isn't directly related to the Tax Act, it has a big impact if you're arguing to me that someone's got more money in their pocket, and I'm not using the DissoMaster to look at spousal support, I'm only looking at child support. Before I make that spousal support order, I'm going to look at cash flow, and you should look at cash flow and tell me, look, if we presume the DissoMaster is right about the taxes, after paying taxes, this is where they would have ended up. So, Your Honor, how much shifting are you going to do of the money between these two folks? And again, all of those smaller adjustments or larger adjustments that you want to be making to a Schedule C, you can turn the lights on now, thanks. To a Schedule C where we've got a sole proprietor who's claiming too many business expenses, you could add them back in on the DissoMaster, or you can ask me to add them back in. But again, explain it. The last thing I'll say is that for me, I prefer, and each judge is different, I prefer that you don't give me a DissoMaster, because it feels like you've done, something about it's like, I didn't do that. I don't know what to do with your DissoMaster. I do know what to do if you give me a simple declaration which says, here's where the money goes. It's self-employment, it's partnership income, it's dividends, it's stock, and here's how much we want you to put in, and here's where I get that number. Because you've just saved about 20 minutes of oral argument, and I can then play with those numbers in chambers while I'm trying to run child support and spousal support. So it's just a one-page, in a declaration from your client, this is my self-employment income. I took it off of my 1040, which I've lodged. My Schedule C is attached to my I&E. This is where the numbers relate to each other. Or we want you to add back in this depreciation, Your Honor, or we want you to consider that there's money there that he's not claiming from whatever source you see it. And tell me about that, where you get the number, give me the lodgement that shows the basis for that, and then I can run the dissomaster, and I'll know where I am when I come out. And if you like to give the dissomaster, go ahead. It's not that it's bad, but I'm not going to just, I for one, I'm not just going to pick up your dissomaster and use it, and you can't open the fields and print them. So I don't really know where you put the numbers. So I hope that's helpful.
That's great. Any questions?
I have a question for spouse support. This is mostly for temporary support. I think so California doesn't follow the federal rules where you can still deduct spousal support on your state tax return, right?
No, you can. California says it's taxable. Yeah, let me show you where that is.
You can, right?
Yeah, in the program.
But the problem I see is a lot of times.
Where's the program? I'll show you one second.
On the tax settings.
Yeah. So if you go to the tax settings, this tab. Yeah, you put the lights down for a minute. I just double checked this because I wasn't sure it was doing it. So you can see that for the tax settings for the feds, right here, it's saying it's not, spousal support is non-taxable, spousal support is non-deductible, no matter who gets it. On the state settings, the default is, lo and behold,
Right.
taxable and deductible. So that's in there unless you go in and change it. So when it's giving you cash flow, the question is, and this will be our greater question, I don't know if it's giving me cash flow. I think it's based upon federal tax return, not state.
So the question, Chris?
And so the question is, then when we're doing temporary support orders, because rarely have I ever seen, if ever, a support order where it says this support is non-taxable, non-deductible for federal purposes, but it's taxable and deductible for state. So when you're doing a temporary order, the default is non-deductible, non-taxable federal, taxable, deductible state,
Yeah.
which gives you a higher support number. So then, are you also manually going in to adjust that tax setting? I don't know if that's commonly done. I've seen a lot of times where it's missed.
I have to, and I'll go back and play with that. I'm guessing that this cash flow is based upon federal taxes. I don't know if it's blended. I'm sure that we could figure that out if we went into it. And certainly to get an argument, it's not going to be a huge difference in income, but to get an argument that, well, this cash flow isn't accurate, Your Honor, she's going to have actually less because she's paying taxes. We have to look to see where this cash flow number is coming from. I'm guessing, as I said, it's federal.
Yes.
On temporary support orders that go back to 2018, in most of my cases, we're assuming that they are still fully deductible federal. I haven't, maybe this is directed towards the tax gentleman, I haven't seen any regs that really spell that out. Most of us assume that once the order becomes a permanent order in 2019 or 2020, then it's under the new federal rules. But are we grandfathered in under temporary support orders that started in 2018?
Okay, I'll defer to you guys more on that, but the spousal support rule, they branched it out, and it was retroactive beginning of the January of the year of
January 2019.
2019.
Right.
So
Yes.
the MSA
Sorry, so they moved it
signed.
forward. So yeah, so the Tax Judge Act was effective
Right.
a year prior to that, and they effected it later. So
But
what's
where we're in limbo is on the temporary orders.
We don't know.
We don't know.
Still
if
don't
it's-
know.
there's no template.
We don't know. I think you should ask us always as the judge to say, I am continuing orders from the temporary. That's what we've been told to do to give you the greatest chance if the parties want it. But we don't know, there's not been a case yet, is my understanding. I wanted to point out just one other thing, and that is the tax guys could chime in on this. When I was reading about this, there has been a change with this qualified business income tax deduction, where it's 20% of your income in certain situations is exempt from tax. Am I explaining that right?
yes, yeah.
And there is a place on the that's new, there's a place in the dissomaster to insert it, which I also had never noticed, because no one's ever asked me to do it. And you're only gonna see that on the tax return, right?
Right.
Because that's where it will be listed.
And that's a big deduction, which would increase the tax.
Absolutely, it can be huge.
Yeah, it's big, yeah.
Yeah, so don't miss that. Again, it's kind of like flagging issues in a law school exam. You're not going to be the tax expert, but now you know if you've got a guy on the other side who's running a partnership, because it's going to be partnership folks, right? Who can claim that?
No, and sole proprietors too.
And sole proprietors. If they're claiming that on their tax return, march over to your tax expert and say, what does this mean? And put it on the dissemester, because it's gonna make more income available for support.
Our job is to, depending on who we're representing, but to define more income, or it's not as much as you think it is.
Right.
Either way, but you gotta search.
I would cut out the questions, but since it's the partner putting this on tonight, we have to allow that question.
Your Honor, I have a question for you. When you did the dissemester, you put for self-employment income, did you just consider those who have Schedule C versus those who have K-1s or income from partnership under other taxable?
Well, I tried to find out where the dissemester wants you to put it. And the best I could come to was that if you have a K-1 or you have a LLC, it should be under other taxable. If you have, so that royalties, partnerships, S Corp, that's where that's supposed to go under other taxable. And that the self-employment income should really only be sole proprietors who are putting a Schedule C. That appears to me how the dissemester is doing the taxes. If it's a corporation, of course, it's going to go under dividends, it's going to go under stock, disbursements, or wages. But it appears, and you all may want to play around with this and shoot me an email if I'm wrong, that the dissemester is considering self-employment income really only sole proprietors who have a Schedule C. That if there's an LLC or a partnership or an S Corp, it's going to go other taxable on that line of royalties and partnerships.
Yeah, and then the issue is, do you have payroll tax on it?
Exactly, it's the Social Security, but the Schedule C, a sole proprietor, they're not having FICA and stuff deducted, are they?
Still,
So for the Schedule C, they are.
Well, yeah. I mean, if it's Schedule N coming in, then it'll show up on the front page as self-employment income, yes.
Okay, so that's the difference.
And then it added now the line item for that is additional deduction.
Right.
Which should be used.
Yeah, and I
Why is there
think
a
this is,
difference? Why is there a difference in numbers instead of that half? Why was it higher when you put it under other taxable versus under Schedule C? What is the difference then?
Okay, because so now with the new Tax Job Act, there's an additional 20% deduction that you're entitled to as a self-employed on your income, so an additional 20% deduction. So since it comes on a different line item on the tax return, so now when you're inputting that number into the system, it created an additional box because there was no way for them to pick it up if you would have entered it in the program, because it comes on a different schedule on the return.
But then there's another box for qualified income that will give you the 21% deduction that you also have to enter information.
I don't know how this box works, but I know,
Check the DISO manual.
But from what I know, all other, if it's a part, would go through, your K-1s and the LLCs would be on the other one. Schedule C would be in the Schedule C. We added this additional box because of the Tax Cuts Act to give the more disposable income to the taxpayer.
I mean, the qualified business
Yeah, the
income.
qualified,
Yeah,
yeah.
that's been added.
But I don't know
think
how
that
the
was there
program
before.
works, just because I'm not, this is more a family level question.
Well, and the other thing I'm not sure about, as I'm sitting here thinking, it's an art grader question, is for people who are getting just LLC, partnership, proprietorship income, how is the program handling FICA and other things? Because it's not being deducted when they get their K-1, right? Or they get their...
On an S Corp it is. On an S Corp it shows as W-2 and then S Corp pass their income. But if it's a partnership, it may not.
Yeah.
So for all of the corporations, then if they take a wage, then the wages will be there in the
Of course.
self-employment, and then the rest will flow through no self-employment tax.
Right.
So that number, we don't need to account for it. On the Schedule C side, then you have to account for it, because now you have the additional self-employment tax, the income, and now you get that additional deduction.
Right, so
So you don't need to worry about it on the entity side, because it's not much of an issue.
But I
They come
think
out through the
the
wage.
program is still calculating that at some point, their income is minus whatever they're
Really?
gonna
Okay, so I
owe.
didn't know that.
I believe it must, because you're still paying those taxes, right?
Yeah. So I mean, I'm sure there's a way that we could cross-reference this program to an actual return. And,
You can.
yeah, and then we could, you know, I'd probably double check. I mean, now that I hear that there's this new box, you know, recently, it's
Well-
probably worth double checking that you are getting the credit.
We're gonna put
This
you in
is-
touch with Art.
This is something that, those of you, how many of you have ever tried to understand what our creator just explained to this? But Art used to
Call it
always
disco
say,
master, you know, let's
yeah,
start dancing.
and he doesn't do it anymore because now he's not the owner, but he used to say to me, and I could never quite do it when I was in practice, get the tax return out of the DISO, create a tax return in the DISO master that mirrors the party's tax return that you're using, and then see what comes up. It was a little beyond my technical skill, but I can see why that would be useful, and you can we can open tax, it generates a tax return. And if it doesn't look like the one that the person submits, and assuming it's correct, but understand that. So that's another, for someone of a really high income, it's worth doing.
And you don't need to contact a tax attorney. I mean, any CPA would love to build a relationship with you guys, and could run these tentative numbers for you, work. So you don't need to use a tax lawyer. Any competent CPA, I believe you should get relationships with them and have them, and they could have somebody in their office assist. But it's 100% worth the double checking right now, considering all that's changed. Alimony, the deduction, just pretty much everything's worth the double check.
And we need to wrap this up, so first of all, I'd like to thank all the foundation for your participation and helping us out tonight, and we'll pass those down. So, I'd like to thank everyone for braving the rain and coming out tonight. Hopefully you have some more insight into the Tax Cut and Job Act. What's changed, what hasn't changed. Remember, educate your judge. It pays to put a section in your declaration for your DISO master, and if all else fails, jazz hands. Thanks.